The raise had already been deposited for 3 months before the higher auto withdrawals began to feel permanent. By 42, the salary number looked respectable on paper. The base pay had climbed steadily through two promotions, annual bonuses had become predictable, and the direct deposit every other Friday carried a larger figure than it had a decade earlier. Colleagues spoke about finally hitting their stride. The household income statement reflected progress. But the checking account told a quieter story. The mortgage payment had increased 2 years earlier when the family moved from a starter home to a larger property in a stronger school district. The decision had been presented as long-term stability. Property taxes adjusted upward after reassessment. Homeowners' insurance premiums rose in response to regional weather patterns. The escrow shortage recalculation added another incremental amount to the monthly draft. None of it felt dramatic. Each increase had documentation attached, a letter in the mail, a line item explained. Around the same time, two car payments replaced one. The older sedan that once carried both commutes became unreliable. Repair costs grew less predictable. A new SUV entered the driveway with a 5-year loan at a rate that seemed manageable within the new salary band. The second vehicle followed 18 months later, when work schedules shifted and flexibility became necessary. Both loans were fixed, both were automatic, both were justified. Health insurance deductions rose annually during open enrollment. The employer absorbed part of the increase, but not all of it. The family selected a plan with a lower deductible after an unexpected outpatient procedure exposed the strain of a high deductible option. The payroll deduction increased accordingly. Flexible spending contributions were adjusted upward to anticipate orthodontics and recurring prescriptions. Retirement contributions also climbed. The percentage had been set years earlier, with the intention of gradual increases. Each raise triggered a 1% escalation in 401k deferrals. The logic had been sound. Future security required present discipline. The gross income rose, so did the pre-tax withholdings. At first, the adjustments felt like markers of advancement. Larger home, reliable transportation, comprehensive coverage, responsible retirement savings. These were the visible signs of mid-career stability in a middle-income household. What changed was not the presence of these expenses, but their proportion. Utilities in the larger home ran higher than in the previous property. Heating and cooling costs expanded with square footage. The Homeowners Association introduced a special assessment for infrastructure repairs. Landscaping services replaced weekend yard maintenance after work travel increased. Internet service was upgraded to accommodate remote meetings and schoolwork. Streaming subscriptions multiplied quietly across devices. None of these decisions were impulsive. Each had a practical rationale. The household calendar was fuller than it had been in the 30s. Time compressed. Convenience became valuable. Childcare expenses that once dominated the monthly budget had transitioned into after-school programs, summer camps, travel supports, and activity fees. The line item did not disappear. It evolved. College savings contributions were initiated when the first child entered middle school. Automatic transfers to a 529 plan began modestly, then increased after a conversation about tuition trends at a local state university. Federal and state tax liabilities grew alongside income. The marginal rate shifted upward. Itemized deductions narrowed after tax law changes. The refund that once arrived each spring diminished, replaced by a smaller balance due that required quarterly adjustments. The payroll department recalibrated withholding, resulting in a slightly smaller net paycheck despite the higher salary. By 45, The gross income had reached a level that would have felt distant at 30. The professional identity was secure. Performance reviews were steady. The career trajectory appeared stable, if not accelerating. Yet, the fixed monthly outflows had formed a structure that did not contract when variable spending tightened. There were fewer discretionary purchases than outsiders might assume. Vacations were planned carefully, often paid for over several months. Dining out occurred less frequently than during earlier years. Clothing purchases were intentional, work focused, durable. The visible consumption did not explain the financial pressure. It was the base layer that had thickened. The mortgage, property tax, insurance, auto loans, health premiums, retirement contributions, college savings transfers, utilities, service subscriptions, and installment payments for home improvements formed a predictable floor. Before groceries, gasoline, or incidental spending entered the equation, a substantial portion of monthly income was already committed. During peak earning years, this structure rarely announces itself as restrictive. Income is sufficient to cover it. Credit scores remain strong. Bills are paid on time. The household appears stable. The realization arrived gradually, not as a crisis, but as an observation during a routine review of the online banking dashboard. A comparison between net income and total fixed withdrawals revealed a narrower margin than expected. The percentage of income allocated to non negotiable commitments had crept upward year after year. There had been no single dramatic choice, only cumulative adjustments aligned with a rising salary. When interest rates increased nationally, the adjustable rate home equity line, opened years earlier for a kitchen renovation, reset at a higher percentage. The payment recalculated automatically. It remained affordable, but the margin tightened further. Insurance premiums rose again after regional claims data shifted. The auto insurer adjusted rates due to broader market trends, not individual driving history. Employee retirement match formulas changed subtly during a benefits update, altering the optimal contribution threshold. Maintaining the same percentage required slightly higher employee input to capture the full match. The deferral rate increased again. Each change was rational. Each was incremental. Together, they redefined the baseline cost of maintaining midlife stability. There was no sense of excess. The home was not extravagant by regional standards. The vehicles were practical. The neighborhood was middle class. The children attended public schools. Retirement contributions aligned with commonly cited benchmarks. Still, liquidity declined. Emergency savings remained intact but did not grow at the pace anticipated when the salary first crossed into six figures. Investment accounts accumulated steadily through payroll deductions, yet accessible cash felt constrained. Large unexpected expenses, roof repairs, medical bills after deductible resets, tuition deposits for academic programs required careful sequencing. Conversations about career flexibility shifted tone. Earlier in the career, lateral moves or industry changes had seemed plausible. By the mid 40s, the fixed expense structure reduced tolerance for income volatility. A temporary pay cut would have required more than minor adjustments. It would have required structural change. The realization did not produce panic. It produced clarity. Peak earning years coincided with peak fixed obligations. The household income was at its highest historical level, but so were its automatic commitments. The financial system that had been built over 15 years was efficient, optimized for stability, and largely inflexible. When annual raises arrived, they were absorbed quickly. Property tax reassessments, insurance adjustments, healthcare premium increases, and higher contribution percentages consumed portions before the net impact could accumulate meaningfully in cash reserves. Lifestyle inflation was not visible in discretionary categories. It was embedded in structural upgrades made at each stage of progress. The larger home aligned with family needs. The safer vehicles aligned with commuting demands. The stronger insurance coverage aligned with risk awareness. The retirement contributions aligned with age. The college savings aligned with timeline. None of these choices were irresponsible. They were sequentially appropriate. But appropriateness compounded. A decade earlier, fixed expenses had represented a smaller fraction of income, leaving room for experimentation, relocation, or temporary reduction in hours. In the present configuration, the cost of maintaining current commitments limited those options. Geographic mobility became constrained by housing market conditions and interest rates. Selling the home would mean relinquishing a favorable mortgage rate obtained during a low rate period only to re-enter a market with higher financing costs. Staying required continued income at or above current levels. Employer-sponsored benefits tied health insurance to employment. The idea of stepping away from full-time work carried implications beyond lost salary. COBRA premiums were calculated and briefly considered during an internal restructuring rumor at work. The projected monthly cost was significantly higher than payroll deductions. The scenario remained hypothetical, but the numbers were recorded. Midlife brought greater awareness of risk, yet less tolerance for it. Colleagues in similar age brackets described comparable patterns. Promotions brought higher pay, but also relocation expenses, private school tuition in certain districts, increased professional wardrobe costs, larger charitable commitments, and higher tax exposure. The external markers of advancement often concealed heavier fixed baselines. Some households reduced discretionary spending to maintain comfort. Others refinanced debt when rates permitted. Some delayed home maintenance, stretching replacement timelines for aging systems. These adjustments modified the edges but did not fundamentally alter the core structure. The core was contractual. Mortgage terms extended 30 years. Auto loans ran 5 to 6. Insurance premiums recalculated annually but rarely decreased. Tuition savings contributions were scheduled through high school graduation. Retirement deferrals were long-term by design. Service subscriptions renewed automatically unless actively cancelled. The compounding effect was not explosive. It was gradual, almost polite. At 48, reviewing a decade of financial statements revealed steady upward movement in both income and fixed expense totals. The ratio between them had shifted more than memory suggested. Earlier raises had felt expensive. Later raises felt absorptive. There were still discretionary choices. Travel occurred occasionally. Dining out was not eliminated. Home improvements were completed in phases. But the margin for error narrowed. When the company announced a reorganization, the internal response was less about career ambition and more about continuity. Severance scenarios were evaluated privately. The household budget was examined for potential reductions. The largest line items were the least flexible. It became clear that peak earning years did not necessarily equate to peak financial freedom. They represented the period when the financial architecture was most developed, most layered, and most demanding of consistent income. The realization settled without drama. There was no singular moment of regret or crisis. The house still felt like home. The cars were reliable. The insurance coverage provided reassurance. Retirement balances were growing. College savings accounts showed steady accumulation. The system functioned as designed. It simply required sustained performance to continue functioning. Even as children approach college age and certain expenses prepare to transition, new categories waited. Potential tuition payments beyond savings projections, aging parents requiring support, home systems nearing replacement cycles, long term care insurance discussions, catch up contributions for retirement. The landscape did not simplify, it shifted. Looking back at early career years revealed more volatility but also more elasticity. Income was lower, but obligations were lighter. Choices carried less structural weight. The present offered higher earnings but denser commitments. In the online banking interface, the list of recurring payments scrolled longer than it once had. Each entry represented a decision made in a prior year, often with optimism, sometimes with caution, always with rationale. Together, they formed a durable framework. The raise that once symbolized advancement now flowed into that framework with limited friction. It did not accumulate visibly in the checking account. It reinforced the structure. Peak earning years, it turned out, were not defined solely by income levels. They were defined by the maturity of fixed expenses that had grown alongside that income year after year, until the baseline cost of stability stood nearly as tall as the salary that supported it. The household remained stable, the bills were paid, the retirement accounts grew, the children advanced through school, the loan was maintained, the vehicles started each morning. The system continued, steady and intact, requiring the same level of income next month as it did this month, and likely the month after that.